Good day, investors. Today we are going to look at Birchcliff Energy, which is a Canadian natural gas producer. We're going to look at what the company does. Do I understand the business? How do they make money? We're going to look at the moat. Does the business have any lasting competitive advantages? We're going to look at management. Are the people running the company skilled, trustworthy, and great at allocating capital? And finally, we're going to look at margin of safety. Am I buying the stock at a price low enough that I'm protected if things don't go perfectly? So this slide I took from basically Peto's presentation because I think it explains the story perfectly. So you can look at here that hydrocarbons continue to dominate, representing over 85% of the world's energy consumption, despite decades of diversification. So natural gas shows strong growth, 2.2% compounded annual growth rate since 2000, and now makes up 25% basically of the mix. Coal and oil remain pretty strong, and nat gas is basically growing faster than even those two major areas. Down here, you can see that global GDP and energy consumption trends together. So basically the backdrop is that energy demand is growing and then natural gas is growing faster than general demand. Of course, it's cleaner than coal, so it's a good development. If you're not just thinking about CO2 emissions that many would disregard, but just having clearer air. So look at China, how it used to look 10 years ago or 15 years ago, and now in major cities you can breathe finally. All right, so this is their latest corporate presentation. Here I want to highlight that the growing LNG opportunity. So that was generally energy and gas the previous slide. This is specific to Canada. So the growing LNG opportunity on the Canadian west coast. So as the chart shows, North American LNG export capacity is expected to almost double by 2030. And while most of the growth comes from the US, Canada is finally starting to build meaningful LNG projects. So like LNG Canada, Cedar LNG, and you can see them in this picture below. KSI, Lysims, and wood fiber create a path for Canadian natural gas to reach global markets where gas prices are much higher than what producers receive today at AECO prices. So today, Canadian gas is limited by infrastructure bottlenecks, pipelines, midstream, and slow regulatory systems, which keeps prices low and delays new projects. And we'll see how that can change. So on this, we can get a more clear picture on where Birchcliff stands. So I want to show how Birchcliff's production looks like. So you can see 82% is natural gas. They have condensates, natural gas liquids, and light oil. I would like to highlight that the condensates are super good. This is like very light oil. It's in shortage in Canada, so it sells for a premium above even oil. So this is nice. They use it to, because they have a lot of heavy crude, they use it to mix it with heavy crude. It's easier to transport via pipelines if it's lighter, if it's mixed with condensate. And then today, I think they import like 250,000 or something barrels each day because they have like a 700,000 barrel demand daily, and then they only produce like 450 in Canada. Okay, so they have more than 80% natural gas. Right, so in 25, Birchcliff exposed mainly to is exposed mainly to three hubs. Where do we see 26? Okay, 25. You can see AECO, Alliance, Dawn, and Henry Hub. But AECO pricing remains the weakest in contrast. If you look at basically Henry Hub and Dawn is kind of like similar, and then you have AECO here, down, much down. When we look ahead to 26, Birchcliff even shifts even more volume away from AECO and toward higher price markets. In theory, although you can see this 45 compared to 23, it's kind of basically double your AECO exposure, so that's not a really good outlook for Birchcliff, at least for the next year. But basically you want to get away from Canada and get your gas sold elsewhere. Basically this diversified strategy, every other natural gas company in Canada tries to do. And that's the future. Now, let's look at, so the stock price kind of moves, right? So they are up 40% year to date. That's huge. And of course, this period is the Henry Hub spiking higher. They have a market cap of just around 2 billion with a dividend yield of 1.5, and the PE is a bit high, but I prefer more cash metrics than earnings. So year to date, up, reflecting market confidence in growth, diversification, and future cash flow. Although growth maybe not so, they are kind of flattish over the past 7 years, but we'll touch upon that later. You can see that Henry Hub is a bit below 5. It was above 5 a couple of days ago, so now it crashed back below 5. You can say OECO didn't really trend with this up, but this is more futures from their official website. You can see IOCO prices, how it's gonna look like going forward. Usually winter, right, it goes up. And what I want to highlight is that as North American and global gas markets diverge, selling Canadian gas via AECO, so including Europe, US, and Asia, becomes increasingly valuable. So the business case for any Canadian natural gas producers is that you can sell something for, let's say, 2.5 in Canada, 5 in the US, and 10 in Europe. That's your business case. You just want to move the gas. So if you look at this is Canadian natural gas, Canadian dollar per gigajoule, which is 1 gigajoule is basically 0.95. So basically almost 1-to-1 mix. And then you also have to think about the FX of $0.72 to the Canadian. So my point is, if you compare this price with this, let's say, 3.25, basically this value 325 is like 2.5 Henry Hub, so it's like 52% of Henry Hub, so they are like half the price as Henry Hub. So that's your business case, right? You have something you can locally sell for 2.5, you can sell it for almost 5 in the US, and then you can sell it for like 9, 10, 11 in Europe. Okay, so this chart is more specific to them. This is their free cash flow, their dividends next to them, right? And something interesting is that 24 wasn't especially a bad year in general for gas producers, but still they had pretty weak net operating cash flow, and then the capex was pretty normal. So if you deduct from this, you deduct the capex, you end up at like a minus free cash flow. So this chart shows how volatile Birchcliff's basically free cash flow has been. A true low-cost producer can stay relatively stable through gas price cycles, but Birchcliff's clearly can't. Its cash flows rises and collapses with commodity prices. So that kind of tells us their cost structure isn't low enough to buffer against this volatile market, which makes sense given their smaller scale, right? So they are producing around 80,000 barrels of oil equivalent per day. So that's, and with more than 80% of your production mix being natural gas, a bad gas year can hit them harder than lower cost producers. Now, looking at this, first I want to start with share dilution. So this is 2018, then this is Q3. Shares diluted barely, so like 2.8% shares dilution. Barely, but still you would want to see buybacks. Production grew 2.6%, so from 771 to 791, so they are basically flat. They diluted more than they increased production, so this was 2.6%, right? And their reserves, sorry, no, this is debt to equity, reserves are up there. So their reserve is kind of moderated from 55 peak to 24 bottom. Not bottom, actually 22 was the bottom, but 24 is still pretty low, so their debt is fine. Although let's look at the other side of that story. First, I also want to mention, because we looked at production here, that reserves are basically flat. So they had like a 1,002 million barrels of oil equivalent, and now they are below that. So they are 970 million barrels as of 24. So that's like a 3% decline of their reserves. How that looks relative to production. So instead of 35.5 years, you have 33.5 years. So their reserves are pretty huge, but still declined, and production is kind of flat, a bit up. So it's not really a good outlook. Although you could argue that they didn't want to produce into an environment when gas prices are not that nice, so they are just sitting on reserves. Okay, looking above, coverage ratios. This is basically EBIT divided by interest payment on their debt. You can see they are pretty volatile. You want to kind of see like 5 coverage every year. It's clearly not the case. and they are pretty not there. Although they have a current ratio of 123% as of Q3, so they are not going bankrupt, but I don't like this coverage ratio. This is pretty unhealthy. Year to year, of course, 22 was huge profits, so that's another story. And then if you look at their debt, basically cost of debt, they paid down a lot of debt here, so maybe they held on some higher yielding debt, or this is kind of an anomaly, right? Because they pay down the debt, but in the financial statement, they already show at end of the year, hey, we have, like, let's say, what was this? Like 10% debt to equity, but we paid interest on the whole year. So they are showing higher interest rates than actually is the case. Today, they are 6.7. So that's their cost of debt. It's not sky high, but it's pretty high relative where Canadian interest rates stand now. But it's not sky high, but it's a bit, but with their debt to equity down. So my point is they have low debt to equity, but their coverage is still weak, and they are paying a bit pricier interest rate above their local government 10-year. So not a perfect debt profile, despite low debts. Okay, so Birchcliff's executive pay consists of base salary, right? Annual incentive awards and long-term equity-based incentives. Annual incentives are tied to overall company performance. I highlighted some items here. Production, adjusted funds flows, free funds, capital costs, operating costs, reserves addition, common share price performance, health and safety, blah, blah, blah. But my issue was when I was looking at their manager structure, their incentive structure, is that I didn't see a clear KPI scorecard for the CEO, which I would want to see. So it was more generic. We are looking at these things, which is good. This is our performance, which is okay, like total shareholder return type of stuff, but not a clear scorecard. So I'm liking that. When I don't see that from a company, I'm always a bit sad and disappointed. Okay, looking at this, so if you compare, let's say this is what we're gonna use for our discounted free cash flow numbers. You see, this is the production they are aiming at. They are saying this is, where is the capital? Okay, so this is their capex, right? And then for 26, this is what they say. This is basically, if you compare, let's say 80,000 to 84,000, that's a 5% growth from 25 to 26. So my issue with that is that historically, they are basically flat with production. That was 2.6% over that period we looked at. So basically 0.3% compounded annual growth rate. So I don't see how they can do this plus 5% when historically they didn't do. You can also see it here. So they had this ramp up, and then I looked at 28, and till now, actually look at this, they are kind of down compared to 24. So they are kind of flat, and then they project the growth. So just keep that in mind, that their growth is kind of not historically supported, right? At least not the couple of X years. And then this is the reserves, how they calculate. 2P is like proven probable. They have good reserves, I give them that. And we'll see how they grow. Okay, so when we look at Birchcliff's historical returns, return on equity or return on investment and free, I use calculations based on free cash flow, so that's why you see negative here, because 24 was a negative free cash flow year. So outside the exceptional 2022 gas spike and the energy spike, the company hasn't delivered strong or consistent profitability over the past 8 years. This reinforces the point that Birchcliff is not a true low-cost producer, right? So in a weak or normal gas markets, their returns compress, and that volatility shows up across almost every metric. This goes out of the window. If they can finally, Canada as a whole, can export their gas, they're gonna do fine. They are gonna make a lot of money. That said, the past doesn't fully reflect, right? So Birchcliff's future, because 2018 to 2025 were mostly weaker gas years compared to what is expected from the future. So to value the business properly, we kind of need to look forward using their 25 and 26 guidance. So I built, and then this is the guidance from the previous slide. So I built, and then here is your capex. It's here. So I built this discounted free cash flow model using production mix of basically this is your gas and this is the other parts. I used modest gas price improvements and the 10% discount rate. Condensates help support margins since it sells at premium, but you can see just gas dominates them. So the model in the end gives a value of about 5.6 Canadian dollars per share, right? Compared to the current market price of, let's say, 772. So based on these assumptions, Birchcliff is trading at a premium to intrinsic value. I try to use the same ruler for every oil and gas company I look at, same prices, same benches, and then we can compare with the ruler. I just put the ruler next to different companies, and then you can have a relative good comparison. This is their 10 cap if I annualize their 25 Q3 year-to-date numbers, and this is their 7-year average. So they are pretty close to their discounted free cash flow because there is not much growth ahead, because I used 20, so 25 I used what they gave, 26 I used what they gave. And then for 27, 28, 29, I just used 26. All right, to summarize, Birchcliff is a Canadian natural gas producer operating in a sector that could benefit if/when global prices converge and Canadian infrastructure expands. So if the Canadian low 2.5 catches up to the US 5 or the global European 10, 11, that's your business case. If that conversion happens, conversions, they are going to make a lot of money. The upside depends heavily on pipeline and LNG build out, which is influenced by regional regulation and government support in Canada. On the moat side, the company has no real moat. As a commodity producer with smaller scale, it's a price taker, right? And its weaker return equity and investment and volatile cash flows show that it is not a true low-cost operator compared to its peers, right? We looked at a couple of companies which control their cost much better. Although they have very nice reserves, which positions them very well long-term. So if the theory is solid that gas prices should converge globally, then they're going to be in a good position. Maybe they're going to be taken over by somebody who wants their reserves. Management incentives are reasonable, but the lack of clear scorecard makes harder to value them. So their historical return equity and investment, which would be how you kind of evaluate management, have been modest at best, and production has been essentially flat for many years. However, you can make the argument that they have huge reserves, which are promising if net gas prices rise. So basically, management could be justified that, hey, we didn't grow production and we just have a lot of reserves because we are waiting for the prices to be right. I would say it can be interesting for some bigger player to take them over because of their reserves. On the margin of safety side, so using modest future gas prices, flat production, and a 10% discount rate, my estimated value of around 5.6 Canadian per share, while the stock trades just below 8, the valuation offers no real margin of safety and is highly sensitive to natural gas price movements. If prices go higher, because they are a higher cost producer, they are more volatile with their earnings. If prices go higher in Canada, they're gonna make a lot of money, and then they're gonna benefit, right? So every other valuation goes out of the window. All right, putting everything in perspective, what we just discussed, I'm putting the company here. This is your intrinsic value. This is your market price. So they are trading at 27 premium compared to the 10% required return I have based on current projections. Now, if gas prices go higher, they're gonna probably go higher, right? My point is that if gas prices go higher, then ARC resources will go also better than this. And the ruler is the same. So I have the same ruler for ARC as for Birchcliff. So why would I buy Birchcliff if I can buy ARC resources? Same ruler, same story. If gas prices go up, this also goes up, this also goes up, but this is cheaper relatively today. And then it has like a 30p on the Birchcliff side also. So if you enjoyed this video, please like and subscribe. Let me know in the comments what type of companies you want me to look at. I'm building a list. I'm gonna go through them, but it's gonna take some time. Thank you for watching and take care until next time. See ya.